Okay, welcome to episode 3 on the put path. We're going to talk today about how to select underlyings. This is very important because this is going to determine a lot of things about liquidity, about your pricing, about your diversification, and shows you how all of these pieces can fit together to provide you with the best probability of success. So, you've already learned how to open up a brokerage account, how to apply for options trading, and now we're going to get into the fundamentals. What underlyings do you use? So you may be asking yourself, what is an underlying? Well, typically it is an asset that's tradable on an exchange that has a option associated with it. So the option um, types that we use are typically stocks, ETFs, and commodities. So what we do is we have a pool of primarily 12 or 13 underlyings. So these would include big name stock ETFs like QQQ, SPY, IWM, and DIA. Those are the first four. Reason that we use these is because these are widely traded. QQQ is a huge NASDAQ equivalent that trades 100 of the best tech stocks in the world. It is highly liquid. It has names like Amazon, Meta, Tesla, Alphabet, etc. SPY, it is basically the S&P 500. It is the equivalent of the US stock market as a whole. IWM, it is 2,000 of the small caps names that you probably are not as familiar with, like Abercrombie and Fitch, Sprouts Farmers Market, and Fluor. BIA, that is the Dow Jones Industrial Average. That is the 30 large cap US stocks, the big names, United Healthcare, Goldman Sachs, Home Depot, Amgen, companies like that. It's the Boomer Index. It's the one that people are very familiar with, but it only has 30 names. Now, why do we trade these? We trade ETFs because they have a lot of diversification. They have a lot of advantages due to that. You don't have exposure to single stock risk. If you have Apple or Netflix, you have single stock risk where you could have an event that causes the single stock to have a quick downside move, which is the one thing that we are trying to prevent. So if you have a single stock, you could have an earnings miss, you could have an analyst downgrade, you could have a merger, you could have a lawsuit, you could have lots of things that cause that stock to go down quickly. I had a um, naked put on in Netflix. It cratered 20% overnight. There's nothing I could do about it. So I lost big on that. So I try to avoid single stock names where I can for this system. So for the four big ETFs that we utilize, they are slightly correlated, but they still offer some protection from the total stock market risk. So it's better to split it up into four ETFs instead of trading a quantity of four in QQQ. And here's why. There is some underlying diversification between QQQ and SPY. There is even more between QQQ and IWM and more between QQQ and DIA. A lot of times QQQ and SPY move together. IWM and DIA tend to kind of move together, but all four of them typically don't move up and down necessarily as much as it would be as obviously if you had everything in QQQ. So when you have capital available, you want to scale into some of these other names. So what else do we look at? We look at IBIT, we look at gold, USO, V and Q, a VIX equivalent, TLT, SMH, XBI, and XLU. So what are these? So IBIT is your Bitcoin, GLD is gold, USO is oil, VNQ is real estate, the VIX is your fear index, which moves opposite. There's negative correlation to the stock market. TLT is your bonds, SMH is semiconductors, XBI is your biotech, and XLU is utilities. So why do we like these? We like these because we want to have different asset classes. We want to have diversification away from stocks and ETFs. These commodities are largely uncorrelated to your stocks. Bonds, real estate, volatility, these provide additional uncorrelation to the stock market. So we don't want to have 12 stock names that we're trading. We actually only have 7, and we have 5 that are alternative assets. Okay, so the reason why, again, you're going to have some things move up, some things move down. You're not going to have total 12 losers on one day. So that provides you with protection, provides you with risk reduction. So why did we come up with these 12 out of all of the stocks in the universe? Well, I've tried around 70 names over the last 5 years. None work as well, none work as consistently as these 13. The types of things that I've seen that are, drawbacks and things that we don't like are the bid-ask spreads are too wide and you don't have enough liquidity in a lot of the names that are out there. Additionally, you have names that are too low. So if you look at the prices of these indexes and underlyings, they're all typically 80 or above, some far, far above 80. And that helps us with price action when we're trying to get a $5 wide credit spread. You're going to need things to be 80 and above. So again, the names that we like are weekly tradable. They are over 80. They have diversification. They also have the price action that allows us to get around 50 cents on the high side down to 25 cents on the low side for this $5 wide credit spread that we're looking for. So what we're going to do in further episodes is we're going to talk through the mechanics of the trade, how to get the trade on and how to get the trade off, and how do we work through decisions along the way. All right. And that is it for today. Stick with me as we move on to episode 4.